Hey, Happy New Year, everyone. My name is Bert Salazar, and I am the host to the Bert Salazar Retirement Show. So I want to welcome you all to 2021. Hopefully, you all had a great holiday season. Obviously, we had a lot of challenges in 2020 that will more than likely factor as well into 2021, but I'm hoping that all of you had a great holiday season and that you're all ready for the battle in 2021. So obviously that's what we're doing. Today is actually the first video webcast that I do for 2021. And this one is going to be an important one because I'm going to be talking about financial resolutions in 2021 that can maximize your retirement life. And for most of us, whenever the end of the year comes around and a new year comes, we always put together, I would argue that most of us put together, personal resolutions and financial resolutions for the new year. Now, one of the major challenges that I have seen over the years, not only in working with my clients, but it has also happened to me as well, and I see it with many of my friends and family members and so forth, is that we're all very good at putting things on paper. But then when it comes to the execution of those financial resolutions or personal resolutions, it's a different ball game altogether. And I think one of the major reasons for that, and I have gone through the same issues as well, is that you start putting down on paper all your personal goals and your objectives. And then obviously you want to try to build some kind of an executable format that you can gauge throughout the entire year. Interesting enough, about 3 weeks into the New Year's, all of those goals and objectives are pretty much out the door. And the reason for that is not so much that you put on paper goals and objectives, but I feel is that if we were to, instead of putting together goals and objectives, we were actually put together outcomes that we would want to see in 2021. I think a lot of that would change the way that we behave from one year to the next. And I think that is one of the major reasons why most financial resolutions fail in the first 3 weeks of the year because everyone is thinking about the goals and the objectives and not really think about the outcome. So my recommendation to all of you is start with the end in mind. So if you can understand what the end is going to look like, then chances are you're going to be a lot more successful than if you do it any other way. Obviously, I've been working out in gyms for at least 50 years now, and it happens in every January. The New Year resolution is to get in shape and lose weight. So whenever I start the gym, and I already started this week, you see a lot of new faces at the gym that you've never seen before. But normally what happens every year is the first 3 to 4 weeks, gyms are very, very busy. By the time Valentine's Day comes along, you're going to see less and less of those faces coming to the gym. And by the end of the first quarter, yeah, there are going to be a few that are going to stick around, but 90% of them are going to be gone. And that's where the gyms are going to be making all the money because they're going to be charging a fee for people that are not going to be occupying space and they're not going to show up. So those are the major problems that if we can address them, then chances are your personal life and your business life is going to be much, much better in 2021. So I went ahead and jotted down a bunch of notes that I want to cover with you as to what I feel your 2021 business resolutions should be and how to execute them and how to maximize them. So if you're ready, it's going to take me a few minutes to get through these. But if you can apply one or two of these to your business life and to your retirement life, then chances are you're going to be very successful, not only for 2021, but for many, many years down the line. Okay. So one of the first ones that I can tell you is that it would be important starting in 2021 for you to be able to increase your personal savings to 20%. Most people think anywhere between 5 and 10%, but that's not enough. Your personal savings every single year should be at least 20 cents out of every dollar that you make. Now, in a perfect world, you would want to make that 20% savings an after-tax 20% savings. So that means that you're going to have to curtail and take a look at a lot of your expenses and do some budgeting and so forth. But if you're able to get 20%, then that would be a win-win. Now, I have had clients that come to me and say, Bert, I put 10% on a pre-tax basis in my 401k, and then obviously I get the match from my employer. If I do that and then I take an additional 10% after tax, would that be okay with you? And my answer is absolutely. So you can split it. If you want to do 10% pre-tax and 10% post-tax, then that would be a win-win for you and your family from a savings standpoint. I think what's critical to understand is that because Americans are living so much longer today than ever before, saving 5, 10, 15% of your money is no longer going to get you to the promised land. It's got to be at least 20%. So I would say minimum 20%, because if you think about savings, savings is nothing more and nothing less than delayed expenditures, because you're going to be saving money until the day that you retire. And then at that point in time, you want your money to work for you. Now, one of the things that I can tell you about expenditures and savings is that most of the money that all of us are going to need in retirement, we haven't saved and or earned yet. Because by the time you get to retirement, whatever amount of money that you have, whatever pool of money or assets you have in your retirement world, they have to continue to produce revenues and income on your behalf on an annual basis, because otherwise you're going to run out of money before you run out of life. But if you're compounding the problem by not saving enough, then obviously that would be a big issue for you and your family. And more than likely you will run out of money before you run out of life along those lines. Now, depending on your tax bracket, and this is very, very important, you have to be able to create a balance between your taxable, your tax deferred, and your tax-free bucket. Now, I would argue that once again, depending on your tax bracket and depending on the revenues and the income that you generate on an annual basis, the vast majority of your savings should go to the tax-free bucket, because I think we all understand where taxes are going to be in the future. And there's a very, very high probability that taxes are going to be a lot higher in the future than they are today. And because of the fact that you have to live off of the net that your retirement assets are producing for you, the higher the tax liability, the less disposable income you're going to have from one year to the next. So make sure that you balance those buckets in the proper manner. The taxable bucket should not have more than 3 months, maybe at the highest 6 months of savings in it, and that could be for emergencies and opportunities. Your tax deferred bucket, because of all the tax ramifications that those buckets bring to the table, you should not have more than $550,000 in those tax deferred buckets, which would be your 401ks, your IRAs, your pensions, your 403bs, etc. And then everything else should go into the tax-free bucket, where you have your Roth IRAs, your Roth 401ks, your 7702 plans, which are your life insurance plans, and then up to a limited basis, municipal bonds from that perspective as well. So that's important to note that. Now, in order to maintain a 20% savings rate, you have to do a proper inventory of all of your expenses today. And you have to be very analytical about that. Now, by the way, one of the systems that I provide for my clients, depending on what it is that they're trying to do, is a debt management system that I offer my clients. So if you have any questions about that, you can feel free to reach out to me. I'll give you my information at the very end of the webcast. And then I'll share with you how to maximize your payment toward your debt while minimizing all those tax liabilities and minimizing all those interest payments that you're going to be making to financial institutions. And therefore, you can actually recapture a lot of those payments and put them into your personal economy as opposed to someone else's or lender's economy for that perspective. Now, there's also good debt and the bad debt. Now, I would argue that all debt is bad, but some are better than others. So for instance, if you have mortgage debt, in which you have the ability to take a tax deduction on the interest that you pay every year in order to satisfy that debt, then that would be a good debt. But if you have, let's say, credit card debt, in which you're paying 14, 15, 18, 21, 28%, I've seen it as high as 29%, and you're not getting a tax deduction for that, then obviously that's something you need to start attacking first, because that is a really, really bad debt. Not only the fact that you can't take a deduction, but also in the fact that the interest rate that you're being charged is astronomical compared to what you could do out in the marketplace. And there are a lot of things that you can do depending on your finances in which you can minimize all of that debt along the way. So that's also important for you to consider as you move forward in 2021. Now, another thing that is important to for all of us, and I have this conversation with my clients often, is that you have to be able to manage your standard of living, and you need to manage your expenses. I always recommend that my clients should live 2 levels below their means, because if you live right up to your means, and obviously you're not going to be able to save that much, and then you're going to run out of money before you run out of life. Now, I know that most of you have champagne taste, but many of you have beer money. And if you have beer money, obviously you're being a fool, by trying to have champagne taste. You can't do that. So you got to be able to manage your expenses accordingly. Now, I have many clients that not only have champagne taste, but also they also have champagne money. But you know what? I tell those clients that every once in a while it's okay to drink beer from time to time. So you have to be able to manage those expenses along those lines, because if you're not able to do so, then you're not gonna be able to keep that 20% savings rate over the long term. Now you may do it for a few months, because you're engaged, you're motivated, you want to get from point A to point B, but after a while, you're just not going to be able to keep up with it. So, because your champagne taste is going to take over your ability to put that 20% away for you and for your family, and especially for the future. Now, one of the questions that I often get from my clients is, Bert, does it make sense for me to lease or to purchase an automobile? Now, I'm going to tell you, and this is 30 years of retirement distribution planning experience and 30 years of tax planning experience. The clients, and I have many clients, but I have probably close to 300 clients now, and obviously that's where I want to maintain it. But what I can tell you is my good clients that are good savers, they don't lease automobiles, they buy them. And I don't care if they own a business or not, they buy the automobile. And they keep it for 10 years. And they keep it for 10 years because they take care of their vehicles. And obviously they're going to be using those vehicles either for personal business, for personal purposes, or for business along those lines. Now, another thing that people that are not good savers do is they either buy or lease vehicles every 3 to 4 years. And if you take care of your automobiles, when you get to trade in a 3 to 4 year vehicle, that vehicle is fairly new. So why are you going to start that clock all over again? As a matter of fact, I would argue that even my good savers, so ones that buy vehicles every 10 years, and let's say they go on, they finance the automobile and they're paying over a 4 or 5 year period, let's say 48 months to 60 months, even after they're done paying for the vehicle, they keep putting that automobile payment into a side fund up until year 10. Because now when they get to the 10th year, in which they either going to sell that automobile on the outside market, or they're going to do a trade-in or whatever it may be, depending on what's going to be good for them, they already have a lot of money saved in which they can use as a leverage for the next year. Now, one of the questions that I often get along those lines is, Bert, does it make sense for me to finance an automobile, or does it make sense for me to pay cash? What I can tell you from an economic standpoint is that anything that you acquire in this country is financed. I don't care if it's a home, I don't care if it's an automobile, I don't care if it's a piece of property, I don't care if it's a piece of furniture, whatever it may be. If you're acquiring something, you're financing. Now, people will say to me, Bert, how can you say that? If I pay cash, I'm not financing anything. Well, you actually are. Because when it comes to economics, you're either paying interest to someone else, or you're failing to receive interest on your money by paying cash. So let me give you an example. Now, which one of the two is the best? And the answer is it depends. If I can finance an automobile through a financial institution, and the interest rate that I'm going to be paying on that automobile in order to service that debt is lower than the interest payments or the interest rate that I'm receiving on the investment that I have, then I'm going to finance that automobile every single day of the week, because there's going to be a positive arbitrage between the interest rate that I'm receiving on my money versus the interest rate that I'm paying out. Now, if it's the other way around, if the cost of financing that automobile, for whatever the reason may be, credit or whatever it may be, is much higher than the interest payments that I'm receiving on my cash, then it may behoove me to go ahead and pay cash for the automobile as opposed to finance it. So it's always a matter of arbitrage. And I can, obviously, I have the ability, the software program, to help you determine whether it would make more sense for you to finance an automobile through a financial institution, or finance it by paying cash. But always remember that if you're going to acquire something that's going to cost you money, everything that you're going to acquire is going to be financed. Either you're going to pay interest to someone else, or you're going to fail to receive interest on your money by paying cash. Also, when you go to a dealer to buy an automobile, be very careful, because the salespeople over there are going to try to sell you. Number one, they're going to try to sell you a car that you don't need for a price that you can't afford, a payment that you can't afford, so you can impress people that you don't like. See, you know, you can only be stupid so many times. So whenever you do that, make sure that you do a paradigm shift and you start thinking about, what do I truly need? What is going to be the cost? What's going to be the arbitrage on the interest payments that I'm going to be making? And does it make sense for me to buy a vehicle at price A versus a vehicle at price B? So I do a lot of those calculations for my clients, especially business clients, because they're always buying automobiles in the name of the business and so forth. And I need to do certain arbitrages and calculations for them as well. So that's important. Now, also remember that you have to be smart, because at the end of the day, the best teacher is your last mistake. So always take a look at the last mistake you ever made, because that's going to be the best teacher for you and your family moving forward along those lines. Now, as I said earlier, most of the money that you're going to be needing in retirement, you haven't earned yet. Now, if you're using an automobile for personal and business purposes, make sure that you keep a log on the business side to know all your mileage. I always recommend to my clients to use Mile IQ. It's a great software program that you can have it on your iPhone, on your cell phone, any cell phone that you may own, and you're going to be able to keep all the miles, because that way, when it comes to doing your taxes, one of the questions under the IRS form is, can you validate and do you have copies of all the expenses for the automobile deductions that you're going to be taking, whether you're going to take it under the business or you're going to take it as an automobile expense. So always make sure that you can keep track of all your mileage and all your repairs and so forth, because that's important as well along those lines. Now, if you own a business, and many of the clients own businesses, and I do a lot of their accounting as well, not only make sure that you have a good accountant every year that's going to take a look at your business, but I would argue it's even more important that you have a virtual bookkeeper that can keep your business in line. Because if you have the proper bookkeeper, he or she is going to be able to save you thousands and thousands of dollars every single year, just because of the fact that they're going to have the ability to either classify or reclassify certain expenses that otherwise you would have forgotten. And then they're going to work very closely with your accountant to make certain that when they upload your P&L statements, your balance sheets, and your statements of cash flow, that all the numbers are accounted for and all the numbers are properly distributed along those lines from a spreadsheet standpoint. So for those of you that may be interested in hiring a virtual bookkeeper, please reach out to me, because that's one of the areas that my firm specializes in. So I would be able to have a good discussion and give you the idea of, what I may be able to do for you and your business along those lines. So that's important that you do that, because the IRS is going to give you all kinds of benefits when you own a business. But what I find many times when I do tax planning for my clients is that many of their accountants and their bookkeepers are not keeping up to date and are not being progressive and aggressive when it comes to taking all the deductions that the IRS is giving them. Now, there's a big difference, between tax avoidance and tax evasion. Well, obviously, we're never going to do tax evasion, but we do have the legal ability to do tax avoidance, and that's what the IRS wants you to do, and that's why they're giving you all of those preambles under the IRS code for you to be able to take advantage of that as well. Now, if you own a business, another question is, well, can you use the Augusta rule? Yes, I can tell you what it is, but then I would have to kill you, so I'm not going to tell you what it is. But again, there are many different ways so you can take certain tax planning savings out of your business every single year. So the Augusta rule is going to be one of them. So again, if you have any questions about that, you can reach out to me and we can schedule a video conference at your convenience in order to discuss further along those lines. Now, another thing that's very important, and we're getting toward the end now, is learn the impact of the opportunity cost in your financial and personal life. If you ever get to the point where you truly understand what a lost opportunity cost is, then a new world is going to open for you and your family. You're going to have the ability to make much better financial decisions. You're going to have the ability to have a much lower cost per item of purchase. You're going to be able to maximize the internal rate of return on all those personal investments and your personal choices when it came to investments, because you're going to understand what opportunity cost is. And opportunity cost, from a definition standpoint, is nothing more and nothing less than the cost of one decision versus another decision. And many times the arbitrage between the two decisions, the cost savings could be tremendous. I do have a software program, like for instance, if you're going to buy an automobile, whether you're going to do it every 3 years, every 5 years, every 10 years, and want to compare the difference between the two and the opportunity cost between the two, you will realize that the numbers are incredibly high, to the point that for the vast majority of clients that I deal with, the opportunity costs that they have had throughout their entire lives for the bad decisions that they have made from an economic standpoint will far exceed all of the savings that they were able to put away in their retirement accounts because of the fact that they truly had no understanding what opportunity cost is. So if one thing that I can give you as a takeaway out of this webcast, number one, make sure that you're able to put away 20% of your money every single year into retirement savings accounts. And then number two, make sure that you understand opportunity costs, because you're going to be making a lot of decisions in 2021 whereby opportunity cost is going to play a major role. But if you don't know where you're going, any road is going to take you there, and you're going to end up in a bad place at some point in time in the future from that perspective. So that's important for you to note as well. If you've never done it in the past, and this is another good point, start thinking about creating guaranteed cash flow, guaranteed paychecks, guaranteed income in retirement. And two of my favorite tools for you to do that is, one is annuities, because annuities is one of the very, very few products in the marketplace that will give you the ability to create a guaranteed paycheck for life. By the way, your Social Security benefits are an annuity. If you have a private pension from a private employer, that's an annuity. If you worked in the public sector and you have a pension from the public sector, that's an annuity. So having annuities as part of your retirement portfolio is actually going to enhance the internal rate of return on the portfolio when it comes to the distribution rate on a guaranteed basis that no one else is going to be able to compete against. And then the second thing that I would recommend is that, start setting a portion of your money on the side and start investing in real estate. So I do have a lot of experience because I do a lot of that work for my clients, trying to figure out, cap rates and investment rates and, internal rate of returns and so forth. And that's something that my software program can do for you. But start setting some money aside and investing in real estate, because it's a great way of also generating cash flow every single year. Now, it's not going to be guaranteed cash flow like you would in an annuity, but it's going to be the kind of cash flow that is going to be almost guaranteed from a business perspective, because you may have, vacancies from time to time, or you may sell a piece of property, may take a while to acquire another one, and so forth. So, but real estate is a really, really good investment for you to diversify your income risk, and then your overall entire portfolio risk when it comes to your retirement life in the future as well. Now, the final point that I want to make to all of you is that whether you're a business owner, or you're a professional, or you happen to be a blue collar worker, always keep an eye on the ball. Wayne Gretzky used to say that you always miss 100% of the shots that you never take. So my recommendation for all of you is that you need to reinvent yourselves every single day. And you have to reinvent your business every single day. Now, when I say every single day, I don't mean every single day, but you have to keep an eye on those every single day, because you're going to have to reinvent your business and your life at different times throughout your entire life. Now, I know in my personal situation, I have had to reinvent myself. I would argue between 4 or 5 times in the last 30 years, because life changes. Life is a moving target. So you have to be able to understand where that target is going, and what are the opportunities down the line, in order for you to be able to shift and be able to enhance your personal benefits and that of your family for many, many years to come. So take it one step at a time when it comes to 2021 resolutions. Try to at least take one or two of the ones that I have given you. Now, if you can do it all, that would be great. But more than likely, I would rather you use 1, 2, maybe 3 of them that you think you feel comfortable with, and start implementing them, because anything that you do for 21 days is going to become a habit. And anything that you do after 90 days is going to become a lifestyle. So for those of you that want to get a hold of me and pick my brain about any of the things that we've talked about, and/or any of the many videos, hundreds of videos and webinars and seminars that I have done over the years, please feel free to reach out. My telephone number is area code 786-766-1042. My email is Bert, B-E-R-T, at bertsalazar.com, bertsalazar.com. And always remember that not only for 2020, 2019, and all the previous years that have been coming to you, but also for 2021, that my goal for you and your family is kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, thank you so much for giving me a few minutes of your time today. I'm going to be seeing you every single week. We're going to have an exciting 2021. The best is yet to come. I want to wish you and your family a happy 2021 and a healthy one as well. I'll talk to you soon. Take care. Bye-bye.